Okay, we're starting in 3 minutes, people. Officially begins by 11. I'm going to look at the comments in a bit. Give me a second. Give me a second. I'm trying to set things up here. Okay. All right, let's see who's in here. Letutrolo. I probably butchered that. I'm sorry. Welcome to the live. Hey, Titus. Welcome to the live. Uncle Kamor, welcome. ALX, Anele Mabena, welcome. Seppo, Mustafa, welcome. Young WW001, welcome. Kaizen Amante, welcome to the live. Patty, ALX. Patty, how are you doing? I hope you're doing good. A couple more minutes and then we'll get started. As for what we're learning today, guys, it's the same thing. You know me. It's the same thing, and if I say something new, then I say something new. Couple more minutes and we'll get started. Sir Digits, hi, good evening. How's everybody doing? I hope your Monday started off great. I hope that we handled our trades properly, whether it's wins or losses. And if we didn't trade, I hope that everything shall work out for you okay. Patty, that's awesome. I'm happy to see that. I'm going to take it from that smiley that you're doing pretty well. That makes me happy. Sir Digits, good evening to you. Good evening, my lord. I hope you are doing okay. I see the likes, guys. Thank you. Thank you, thank you, thank you. One more minute and we'll get started. Guys, I'm so sleepy. You don't want to know. I am so sleepy. I only got like 2 hours of sleep. I don't know. So I might keep it really short. We'll see how it goes though. Maybe I'll get too excited and stay longer. Less than a minute. 2 and 1. It is 11 p.m. where I am. Good evening, good morning, good afternoon, good whatever time it is wherever you are. Don't worry, we're going to look at charts today. So I'm going to just flip my camera around. I'm not trying to like my live. What's happening? Flip the camera. All right. There we go. There we go. Awesome. So guys, you know the story by now. Sorry if I'm sounding low energy today. Your girl's tired. But I will do my best still. Okay. All right. So as always, we're going to talk about liquidity. I see a lot of familiar names here, which tells me I may not necessarily have to revisit the whole thing, but for the sake of those who will be joining in late, joining for the first time, watching the live on YouTube, we're just going to run the thing again. I think I want to switch to a different template. Let's do this one. Okay. And then let's see about making this easier to see. Much better. Okay, that is perfection. I love that. Okay, so wherever you are, whatever strategy it is you're trading with, I will not convince you to change it. I'm only here to teach you the story of price. And everything that the markets do is all about moving money around. It's all about liquidity. That's all that's happening on the charts, moving money from one place to another. Which is why every time I always say, your job as a trader is simply to identify the answers to these 3 key questions. So let's start off. Your job as a trader. I'm going to make this bolder so it's easy for you to see, and larger as well. Give me a moment. So make that bold and make that maybe about 16. There we go. And probably make that white. White, 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 white. Oh, that's a horrible idea. Let's do blue. No, let's just keep it red, whatever, bro. So, your job as a trader is to answer these three questions. Number one, where is the money coming from? Number two, where is the money going to? And question number three, is there enough room between these two places for me to take some for myself? Those of you who have been here with me for a while, you already know the importance of asking these questions. If you do not ask yourself these questions, what you'll find is you keep taking trades that don't make sense. You take trades when you take a buy when it's just about to turn around. You take a sell when it's just about to turn to the upside as well. You find that you're lost. You have no bias, no direction. You hop into a signal group and the signal group leader says, yeah, we're in for buys today on Aussie yen. And then you hop in for a buy and 5 minutes later, oh, close trade, there's a sell. I mean, it's ridiculous. I'm not trying to judge you if you use signal groups, by the way. I understand wanting that sort of guidance in the beginning of your trading journey. However, if you must use a signal group, I'd recommend you stick with this lesson till the end, because what it's going to do for you is keep you out of the horrible losing trades that your signal provider may be giving you. And it'll give you a sense of agency when you can answer these questions for yourself, and you will feel empowered. Nobody wants to be fed forever. Okay, it is much better to learn how to fish for yourself than to have someone fish for you forever. Because what happens when that person decides enough is enough, or when they are called to glory? You don't want that. So let's talk about why these questions are important. Where is the money coming from? Because that's going to tell you when you should be getting in, or if you should even be getting in the first place. Where's the money going to? Because you need to know when to hop off of that ride. You don't want to take the first dollar that is offered to you, nor do you want to wait for the last dollar. What do I mean by that? You don't want to wait until the very end of a move, because there's always that chance that the market may reverse. So let me show you what I'm talking about really quickly. This is the Euro Aussie, and you're looking at a 4-hour. No, this is Euro Yen, my bad. This is Euro Yen. Let me take it to the 4-hour chart. This is Euro Yen. You're looking at a 4-hour chart right now. Okay? When I say don't take the first dollar that is offered to you, I mean don't start trying to catch tops like these without context. What is the context? It's basically the question, where's the money coming from? And also, don't try, if you somehow manage to grab this or grab a ride somewhere around here, you're not trying to get the whole of this move down to the very final pip. You are looking to take just the middle chunk, just a bite out of it, because you're less likely to have the price turn around and hit you or hit your stop loss. And then there's also the question, is there enough room between these two places? Please do not invite me to co-host. What is this? Is there enough room between both places for me to take some for myself? Why is that third question very important? It's because of a little something I like to talk about called a range. And it's not the same thing as a zone, because a zone, to me, at least the way I interpret a zone, it sounds very vague, very amorphous. But I'm talking about a range. I precisely mean the difference between two price points. In other words, think about the fact that every candlestick on here, this is again Euro JPY H4, not that it matters. Every candlestick on here has 4 different price points. You have the open, the high, the low, the close, right? So this is a bearish candle. You have your open, high, low, and close. For a bullish candle, you have your open, high, low. This is the close here. which means that you can very easily say that a single candlestick could be a range if you are taking the high and the low. If you want to trade with opens and closes, you can experiment with that. I have not and will not. I prefer to use highs and lows. So what did I say once more? The range is a difference between two price points, which means if I have this price over here and this price over here, if the difference here, this difference is the area, the region between these two price points, that is the range. Think about the meaning of the word range. A range is basically a series, okay? And for a series, you have a starting point and you have an ending point, and that's what you're looking at here. Now, if it turns out that the range here, this area is only 1 pip, guess what? It is still a range. It still counts. The reason that it does not count for trading, though, is that it's just 1 pip. So unless you're scalping 1 pip, it's pointless, which is why we have this question over here. Remember, question number 3. Is there enough room between these places, these two places, for me to take some for myself? So it is for this reason that when we are defining ranges, we work with, number 1, high time frames, and or what I like to call, number 2, high range frames. And I'll explain what I mean by range frames in a moment. So high time frames would depend on the particular asset that you're trading. For instance, if it's extremely volatile pairs that give you as many as 100 plus pips in a single day, for instance, like your GBP let's see if I can pull up that here. Give me a moment while I change the template so I don't blind everyone's eyes. Where are we? Ah, yes. So let me open up GBPNZD. GBPN. Right, so let's take a look. You're looking at the 4-hour chart, okay? In a whole week, all of last week, this is last week's price action here. This from the low all the way to the high, you had 200 plus pips. Right? I'd say pretty volatile. I'd say there's a lot that you could take. The week before that, 200 plus. And this pair has a habit of moving violently. Like, for instance, when the market opened, I think I called this in the group, I don't remember. But this is H4. This is that fair value gap, which I will explain shortly if you're not familiar with what a fair value gap is. And look at the way it tapped into it, and 100 plus pips in just, I think it was an hour. Let me drop to the hourly chart. Yeah, absolutely. So why am I pointing this out? A high time frame depends on the asset you are trading. This is GBP NZD and it's crazy, but let me take you to something like NZD CAD as an example. NZD CAD. So remember, I just showed you the 4-hour chart for GBP NZD. Now I'm taking you to the 4-hour chart for NZD CAD. Let's look at the entire range of the price action for this week, right? So let's say it started from this point here all the way down here. It was just 100 pips, all right? So it does not move all that much. I don't think I've said this before, so take notes. You want to pay attention to the asset that you are trading. If it is an extremely volatile asset, then that implies you could look at the 1-hour chart as being part of your high time frame. So from the 1 hour up to the 4 daily, D3, weekly, etc. But if it is a pair or an asset that is not that volatile, you may want to begin at the very least from the 4-hour chart. I personally like to work my way down. I start with the monthly and then I push my way down. By the way, this is a side note for those of you who are looking for the opportunity to take advantage of a massive move. I'm not calling specific pairs, but I want to draw your attention to the fact that this is the 21st of July, which means the month is about to wrap up. And that means a monthly candle will close and it will give you a possible bias for the rest of the coming month, which means you could have one trade that pays you massively. Just something to note there. Always, always, always check your monthly charts. Check them at the start of a new month, in the middle, and at the end. Just a sidebar. So let's go back to what we were talking about, which is the matter of the range and why I said you need high time frames. So because of the difference there, if you are trading NZD CAD, you would want to use a 4-hour chart. If you use a 1-hour chart or less as your supposed high time frame, you may find that you are not getting in the right trades and you're constantly getting kicked out and it's inaccurate. And then you will think that everything I'm telling you here is complete and utter BS, which would be unfortunate. So please use your higher time frames, okay? But if you're going to do something like the GBP pairs, especially GBP CAD, GBP AUD, GBP JPY, GBP NZD, Euro NZD as well, those pairs, they move massively. And so for those, you may look at the 1-hour chart for the things that I'm about to show you. All right? So let's return to what we were saying about ranges. The second thing that I said you need to use to define a range, or that you could use, not that you need to, is a high range frame. And what do I mean by a range frame? Well, by this, I'm referring to using charting instruments or tools that do not track time but price alone. So right now, you're looking at a Japanese candlestick chart. This is the Euro JPY. Each of these bars is worth 4 hours of price action. But you could use either Renko bars or range bars. So what is a Renko bar? Someone asked the question, I'm always mentioning it, and they didn't know how I was spelling it. On the off chance that you don't know what I'm talking about, this is the spelling here, RENKO, Renko bars. So I'm going to make this part of here, put a colon, Renko bars, or range bars, and I'll explain the difference between the two now. So first things first, let me take you to a Renko bar chart. We're still looking here. I need to close this so there's no confusion. All right, taking you to a Renko bar chart now. I will take you to the, let's do a 10 pip Renko bar. All right, so what you're looking at right now looks like a trader's wet dream, right? Look at all of that cleanness in the moves. This is a Renko bar. A Renko bar is not like your regular Japanese candlestick because each of these bricks do not form unless and until the market has pushed by that number of pips. So if it takes 10 years before the market finally pushes 10 pips, then it takes 10 years. You're not going to see this break here. So let's talk about how this chart actually works, right? The market has been pushing down. Look at this red bar here. Just because you see the close price here, so you have just the opens and closes for these bars, just because you have the open, the close, this does not mean that the price immediately turned around at this point. Absolutely not. There is a chance that the markets continued to push a little bit beyond this close price, but it was not able to push as far as 10 pips. Remember, this is a 10 pip Renko bar chart, which means each brick is worth 10 pips. So if the market was not able to create another 10 pips, then it's not going to create another bar. So what happened here instead? Once the market pushed 10 pips here, it pushed back up by 10 pips, okay? But you're not seeing the bar here that indicates the market pushed back up. The market would have to push up by 2 of whatever setting you're using for your Renko bar chart. So in this case, you are using a 10 pip Renko bar chart. For it to switch to the opposite color, it would have to move up by 20 pips. All right, if it was a 5 pip Renko bar chart, it would have to move up by 10 pips, etc. So same thing here. Just because you're looking at this clean open and this clean close does not mean that there is no price action that took place here. As soon as this bar opened, it's possible that the market may have pulled back a little bit. And as soon as this bar closed, it's possible there was some fussing around. Like, just imagine this isn't here right now. You would not see much other than this attempting to build itself. But if it had pulled back, you wouldn't see the price action here. All right? Same thing here. Look at this top. Just because it closed there does not mean that was an immediate turnaround in price. No, it may have messed around a bit here and then turned back. So when I talk about high range frames, this also is relative to the pair that you are trading. For instance, I personally would not use a 10 pip Renko bar chart for a pair like, let me pull up an example. Let me take you back to the GBP NZD, which is a crazy, crazy pair. I would not use it for this. I'm not letting this trick me into wanting to use it. And why is that? Because sometimes we arrive in all of this mess here. Sometimes it can get really messy because it's a very, again, very volatile volatile pair. So it would depend. If I was going to use this at all, I would prefer to use a 25. And this is just my personal preference. You go figure out what works for you. I would prefer this. And notice how all of that mess that we found before is so much cleaner. The price is easier to read. So when I refer to a high range frame, what I'm talking about is a range of prices. Remember how we defined a range? I said a range is the difference between two price points. And what do each of these bars have? As you can see, two price points: open, close, open, close, open, close, open, close, etc. So with a Renko bar chart, like I said before, you will not get a new brick. See this? This one's forming. It will not close if it takes up to 5 hours before it finally gives you 25 pips, then it takes 5 hours. It is not based on time at all. And you will notice that these here, let me see if I can pull up my chart, if it's legible enough. No, it's not. So I'll just read it to you. The open and close prices, they tend to be at round figures. So let's see. The open of this here is 2.25500, and then you have the close, which is 2.5750. Remember, that's 25 pips because this is a 25 pip Renko bar chart. So these are ranges. You can literally have a strategy where I don't recommend it. I prefer that you would actually go to a time frame, like a proper time frame, and look for what I'm going to show you later on. But if you're lazy and you are mindful about how much you risk, you can literally just mark this here, and then you go to a lower time frame and then wait to see what I'm going to show you play out, and then take advantage of that. That's how simple what I'm about to show you is. So this is one form of what I would call a high range frame. If I was trading something like Aussie CAD, for example, I would not use personally a 25 pip Renko bar chart because I don't know if you can see the dates on here, but I'll probably just read it to you. It would cover a lot. So unless I'm willing to hold for a long time, and not really take any trades at all, okay, then that's different. But if I'm looking to make sure I get a trade, I would drop this down to maybe, and this is just my personal preference, anywhere from 5 or 10 pips. This is a 10 pip Renko bar chart. So again, it all comes down to how volatile the pair you're dealing with is. And as for which kinds of pairs you should be trading, pairs with high volatility or pairs that move slow and smooth, that's entirely up to you and your personality. If you're the sort of person who likes control, you don't like the idea of wide stop losses, you're very quick with it, then you may find it beneficial to look at the slower moving pairs, because on lower time frames they'd actually kind of sort of be fast for you. However, if you're okay with wild swings, and you don't care about having a tight stop loss, and you're okay with taking a few hits before you finally get that one long runner, you can try the GBP XXX pairs. Those of you who trade gold, well, you know what to do. I don't touch gold, so there's that. Not because what I'm teaching does not work with gold, but because I just don't like gold. I like to calculate in pips and keep it simple. The only other thing I will touch is S&P 500, but moving on. So let's come back to our notes. I believe where were we? EURJPY, I think, is where I should have all of that. Yes, perfect. So I have shown you what a Renko bar looks like, and now we're going to move on to range bars, okay? Range bars are my absolute favorite, and I will tell you why. So just like the Renko bar, now this is EURJPY. Let me open up another pair for you. My good friend GBP CAD. And switch that template, please. That's blinding. All right, much better. Get rid of the alerts. Viewing options. Price alerts. Thanks. So what you're looking at right now is GBP CAD, another volatile monster. And what I'm going to do is show you what it would have looked like with a range bar chart. So my favorite thing to do is to put it to a range 50, which means that each of the bars you're about to see have exactly 50 pips. So wait for a second for it to load because it needs time. It's not your regular chart. Here we go. This is a range bar chart, which, like the Renko, it only moves based on price, not time. So let's zoom in on one in particular so I can explain this to you. In this example, when the price puts in a high, if the market's actually if that's an actual high, you're not going to get a new bar until the market actually pushes by 50 pips. So if I measure from here to here, that's 50 pips. Then this closes and this guy opens here, it pushes up and creates that high and retraces from there. And as soon as it pushes down, it gives us 50 pips. I like these for multiple reasons because you can kind of treat them like your regular candlestick charts. That's one. Two, they are literally called range bar charts, which means automatically you have areas that you can look at as areas of interest for where to get in. And we'll talk about that in a bit. And the other thing that I love about range bar charts is you can project where your take profits should go and where your stop loss should go. So, for example, let's say this bar here has closed and this one opens, and then you push this high and it pushes this high and it starts going down, and you've seen on a lower regular time frame some entry criteria. So you can project from whatever this high is down to wherever you find 50 pips will be, and then from that entry point you would know where your take profit would be. It's just one example of the things that I love about range bar charts. So let's return to our notes here. Quick little recap. Your job as a trader is to find out where the money's coming from, where the money's going to, and if there's enough room between those two places for you to take some for yourself. And like I've said, the way to define questions 1 and 2, the answers to questions 1 and 2, is to understand what the range is. And I've told you what a range is, that the range is the difference between two price points. And that for question number 3, you want to make sure you were using a high time frame, because a high time frame would have a lot more pips for you to work with than a lower time frame. Same thing with a high range frame if you're using a Renko or the range bars. Now, what does all of this have to do with this money here? It's the concept of liquidity. That's what we're talking about. But what exactly is liquidity? Liquidity is money. It's the same money that we're talking about in these 3 questions here. When you have a range, it's easy for you to define exactly where the liquidity is. You can tell at any point in time what the big boys and girls are doing on their charts, and you can take part in that ride. And you'll find that no matter what strategy you're using, because you don't have to change your strategy. I'm just explaining to you a framework for how you can interpret price action. Whether you're using support and resistance, you're using break and retest, or the stuff that people would consider basic, whether it's Malaysian SNR, whatever fancy strategy you're using, when you add liquidity to the mix, it's going to help you sharpen your trades and figure out quickly when you are wrong, as well as where you should take profits, what you should expect as a possible target, etc. So anytime you see the word liquidity, it's simply money. Now, there are 2 kinds of liquidity. Generally speaking, you have number 1, internal. Now let's start with external range liquidity, which literally means money outside the range. And then you have number 2, internal range liquidity, which is money inside the range. All right? Now that you know what these 2 are, let's first talk about external range liquidity. You can find these at highs and lows. Why highs and lows? Think about how I defined a range once more. I said it's the difference between 2 price points. You have these 2 lines here. This is literally, excuse me while I get rid of this. I don't want it distracting us. This is literally a high and a low. Let's make it thicker if that matters. All right, that's a high and that is a low. Those are 2 price points. But how do you actually define them? Do you want to just draw random lines on your chart? I mean, you could do that at round figures. That would be like mimicking a Renko chart. Or you could go to a high time frame. This is the 4-hour chart, and you can mark the high and the low of a single bar chart, of a single candle. and use that as a framework to understand what the price is doing. You could work with daily ranges as well, which just means working with the highs and lows of the day or the previous day. You can work with weekly ranges, which basically means the same thing. So, whatever range you select, let's say you're looking at this week here. This is Euro JPY once more. I'm marking the high and the low of the previous week. The whole idea of external range liquidity is that the liquidity or the money you're looking for would lie outside of this range. Remember, the range is a specific area, this area between both price points. So external range, money outside the range, outside the range. And typically what happens, not all the time, okay, is that if the high gets taken, you can expect the market to do something to come and take out the low, or at the very least, give you a retracement. This is the advantage of trading with a high time frame, because what may only be a small retracement on a weekly chart, this is a daily, mind you, but what may only be a small retracement on a weekly chart or a daily chart could on a 15-minute, on a 5-minute be quite an impressive number of pips for you to cash out. All right? Which is why even before all of these questions, you must know exactly what the trend is. And I'm working with the assumption that you have enough experience to understand what a trend is. All right? Because I decided I'm not doing, my audience is people who have tried trading and they keep failing no matter what. So that's what it is. I'm assuming you know the basics. So you must understand that you don't want to go selling every high and buying every low, because that's a recipe for disaster. Just looking at this chart alone, you should be able to see places where that might have screwed you over, okay? You must bear in mind the context of a trend. So let me add this little caveat here for you to read, dragging this over here. Ask these questions bearing in mind the trend. Okay? And the trend is relative. To one trader, market may not be trending. To another trader, because they're in a lower time frame, they see a proper trend. But no matter what you do, I need you to remember that all lower time frames will forever and always take their marching orders from the higher time frames, or higher range frames if you prefer. So now that you know what external range liquidity is, which is money outside of the range, this is the daily range from yesterday that I blocked off. What about internal range liquidity? So internal range liquidity has two different kinds. The first one, let me drag this off here. I need to make sure you can see it. You have, number one, order blocks. Number two, fair value gaps. Now, these are not my concepts, to be very clear. Huge disclaimer here. This was created by a guy called Michael Huddleston, aka ICT. Your misgivings about him aside, his concepts actually solidly work. I have proved it to myself, and it's my hope that you go home and prove it to yourself as well after this live. So I am not taking credit for this. And I should also state that there are multiple kinds of internal range liquidity. But one of the things that I found constantly tripped me up as a trader was that I knew too damned much, and that caused a lot of confusion. So I have come to realize you only need just a couple of things. You don't need to learn everything. Just those things are more than enough for you to make steady money consistently if you apply it correctly. Now, let's talk about what an order block is. All right, so what I'm going to do is I'm going to drop down. Actually, I don't have to drop down. I think I see an example here. I'm going to get rid of these two lines so there's no confusion. Remember, we're looking at the daily chart right now, and this is Euro JPY. So an order block is what you have when there has been a break of market structure. What do I mean by structure? This is a high, okay? You have a high, 1, 2, 3. This is a high here. Why am I saying 1, 2, 3? What I'm indicating by this is a swing. The swing, quite literally, let me just put that down here for your notes. For those of you who don't already have the notes, note, a swing is a turning point in price. What does that mean? I think I need to make this clearer, bolder. Maybe I go with a different color. A swing is a turning point in price. All right. What do I mean by that? I'll show you. So it's actually a 3-bar pattern. You have swing lows and swing highs. The swing highs, you could call them bearish highs if you want, bearish swings if you want to, and the swing lows, bullish swings. But just because they're called that does not mean that you get to sell every swing you see, every swing high, or buy every swing low. No. Remember, everything I'm teaching you is within the context of a trend. And little sidebar here, if you are expecting perfection from what I am teaching you, you are in the wrong craft. You should not be a trader, because trading means being at peace with losing a few trades. A losing trade should not define your entire existence. You should be able to define your success based on a series of trades, not just one trade. Okay? So bear in mind, you must be able to define it over a series, not just one losing trade. Now, coming back to the concept of an order block. This is a high here, 1, 2, 3. A swing high is what you get when you have a 3-bar pattern where the candle in the middle has the highest high and the other two on either side have lower highs. It's reminiscent of the head and shoulders pattern, if you think about it. The reason I am pointing that out very specifically is that sometimes if a swing high plays out on a high time frame like the weekly or the daily, you might be able to exploit that for pips on a lower time frame for a quick sell that may give you, well, it depends on what you're trading, but it'll give you a good number of pips. Now, a swing low is the opposite. You have this 1, 2, 3 pattern where the middle candle has the lowest low of all 3 candles. The other 2 on either side, they're higher. If you think about the fact that the market is fractal, price is fractal, what is happening on a higher time frame is also happening on lower time frames and vice versa. If you go to a lower time frame and break this down, it would look like an inverted head and shoulders. If you're familiar with that, you should be. You all did baby pips or something. You should know what that pattern implies. Which means if you're looking at this on a high time frame, you should be able to exploit it. And in this particular case, what has the market been doing? It's been pushing up consistently, which means if you're seeing a swing low, which I also called a bullish swing, in a market that has been pushing up consistently, that should tell you, if not the next day, maybe the day after that, you should anticipate a push to the upside. Note that one for your studies later. So now that I've gotten that out of the way, let me finally talk about this damned order block. You have a high, the high gets broken. On a high time frame, like a daily chart, which this one is, for me, I consider a break to be if the price trades through that high. But if it is a low time frame, like the pending hourly M30, M15, I don't want to see a wick. I want to see a full close above this high. But this is a daily chart. So keep that in mind as well. The order block, what happens as soon as the market trades through this, see this very last candle here, I will mark it out for you. The last bearish candle that led to this push to the upside that broke that high, that is your order block. Some people will mark the whole thing. Others will just focus on the body. That is entirely up to you. When you notice that you have an order block, okay, and the candle before it is also the same color, you can extend it. Okay? You can absolutely extend it. You can extend it to cover both, or you can use the body here if you prefer. Again, I leave it up to you to decide what you prefer. But in this particular case, let's say we bring it up here. We have this break, and what happens? The market eventually retraces into this order block, and then it reacts from it and takes off to the upside. So the whole idea behind this order block is when it is formed, which is again, you have a high for a bullish setup, a bullish order block, you have a high, it gets broken. Once it gets broken, that candle, or if there's multiple of the same color, those candles, they become the order block. When the price returns into it, you can have a pending order within the order block or at this particular place here if you're using the body, whatever. And the whole idea is you would be entering that trade and looking to target the most recently created high. All right? That's a bullish order block. Let's look for more examples that you can see in action where the market actually respected. Let's see what we've got here. For bullish example, all right. Let me delete this and get it out of the way. Zoom in here. Yeah, I see one. So we have another order block here. Let me change that color so everybody can see what the hell I'm talking about, and also zoom in. So what is this? What you have here is a high. This high gets broken by this candle. This is a 15-minute chart, so I expect for that break to be a full break with a close above that high. So as soon as that happens, what do we have here? This order block. If you wanted to refine it down, you could have. And the market would have still picked you up in this particular instance. It does not always pick you up. Not every order block will get you picked up, and it's okay. It's not the end of the world. If you wanted to, you could have stretched that out all the way up to here. And again, like I said, some people will have it at the body, or if they're having it here, it'll also be at the body. I leave that up to you. In this particular instance, you can see the tap was perfect into this body here. The open of this bearish candle, that order block here, taps into it and rejects it. You have multiple ways of trading that. You can have your pending buy here. As soon as this order block is confirmed, have a pending buy here with your stop loss at the low. Or you could go to a lower time frame and wait for something similar to set up. So now that we have bullish examples out of the way, let me show you bearish examples. This one's a bit tricky. So look here. We have this 1, 2, 3. It's a swing low. As soon as this candle closes below it, because remember it's an M15, so I'm not going to just accept the wick. I need a full close. I need body. As soon as this happens, these become order blocks. If you have a doji for an order block, my advice to you is try to see if you can get something with more body, or if there are consecutive, if they are both, if there are other candles before it that are the same color, try to highlight everything, okay? Because I don't personally see dojis as being significant enough. These ones actually have body, but I'm saying if you see actual dojis like maybe this guy here, yeah, try to look for something more substantial. But anyway, what happens? The market breaks this low here immediately. These are your order block. So the market has to go back and pick up the remaining orders in here, and notice how you have wicks rejecting this. Okay? Notice how the market attempts to push through but fails once, twice, thrice. It's just screaming to you that you should attempt to get in for a sell. Once more, I want to say, nothing in trading works 100% of the time. If someone told you that, they're lying. They're trying to scam you. Please be careful. So, now you've seen what a bearish order block looks like and a bullish order block. I'm going to take you to the next thing that we must discuss, which is the second kind of internal range liquidity called a fair value gap, right here. So what exactly is a fair value gap? I'm about to show you. Give me a moment while I stretch this out to a reasonable proportion. All right, so observe this. We have this high here, okay? 1, 2, 3. This high gets broken by this candle. When this break happens, you're waiting to see what the next candle does. It opens and it pushes up. Boom, closes. When it closes, you are looking at the very low of this candle here and the very high of the candle before the one that broke this high. So it's a 1, 2, 3. And you're noticing that this candle here did not have a wick that traded through the range of this area. And this candle here, its bottom wick did not trade through the range. In fact, all you have is just a solid bullish body here. So that area, I seem to have lost it. Where am I? Was it this guy? I'm not even sure at this point. Yeah, I'm going with this one. So that what you have here, let me change the color, is your fair value gap, bullish version. How do you trade this? You can have a pending order. So this guy closes here, confirming to you that this is a fair value gap. You can have a pending order sitting here and have your stop loss below this second candle or at the lower portion of this, just to be safe. And then you'd be looking to target the most recently created high, or at least from this point to this point, 50% of the range. And I'll explain that in a moment. Let's take a look at another example of a fair value gap. So let's see if I'm seeing this correctly. That didn't get tapped in, but this would count because look here, you have this high, this candle broke it. Once this candle broke it, you're waiting to see what this candle does. It does its thing, and if you look very carefully, and just like with everything, doesn't always work all the time. May eventually become something price reacts to, we don't know. But this gap here, this area where there's no wick, this wick doesn't trade through this one doesn't trade through this, that's another fair value gap. Let's go look for bearish examples. Let's see, what is this pair? Let's go elsewhere. Let's look for, my favorite bearish example for right now until it's done playing out. Yeah, okay. So take a look at this low. This is USD CAD on the weekly. Remember what I said about wicks? If it's a high time frame, I'm willing to look at a wick as a break, because on a slightly lower time frame than this weekly chart, you would see this playing out as an actual break. But that's besides the point. So when this break occurs, you have this next bar here pushing down, then you have this other bar here pushing down. What you'll notice is this gap right here. Changing the color so you can see exactly what it is I'm highlighting and zooming in. Look at this low and look at this high here. And pay attention to the fact that this was all just selling. So it's imbalanced because it's only selling and no buying. So the market eventually trades back into it. And then your job would be to go to a lower time frame, wait and watch for a setup. So let me put an arrow here so we can see how that would have played out. Or I'll just mark this area. Let's go to a lower time frame, maybe the 4 hour. Let's see how that would have played out. So that's around here. Taking this off. This is the area here. So you could just wait for a break in market structure. And in this case, you have this low here getting broken. Then what? When this low is broken, what do you have? This is an order block, right? So you're marking from this point all the way to this point, waiting to see how the market responds to this. And then that would be a great entry for you to take for a massive sell. All right? So that's an example of a bearish fair value gap. I'll show you one more for good measure. Where are we at? Here's another one. Marking this, changing the color. This is a low. The low gets broken by this candle, and then this candle does its own thing. Once it closes, that confirms to you that this area here, this is your fair value gap. All right, making sure it's precise. And what happens? The market trades into it, respects it, and turns right the fuck around. Now, something I want to say is whenever you find you're looking for a really valid order block, because this counts, as soon as this broke, this would be your order block. This is a 4 hour chart. So I might consider that one, even if it's annoying me with all those wicks. When you have an order block that is followed by a fair value gap, think of the fair value gap as telling you that that order block is a high probability order block. High probability meaning there's a high chance that if you take it, it will work out. Just something to keep in mind. All right, so now that we've talked about We've talked about external range liquidity, money outside the range, internal range liquidity, money inside the range. We've talked about order blocks and we've talked about fair value gaps. The next thing I would like to talk to you, my people, about is a little something called, I like to call it PDA. I tell myself it's public displays of affection, but that's not what that is. We have the premium. Number 2, we have a discount. Actually, I want to start with number 1 being equilibrium. Number 2, premium, and number 3, discount. I keep putting premium first because I just like to sell. I've noticed. I love sell setups for some reason. Anyway, let's talk about what these things are relative to the range. So, before I go, thank goodness I remembered. Do I want to talk about that now? No, let's just focus. So, let's go to a regular range bar chart. Give us a second. This is the 50 pip range bar chart. It needs time to populate. This is CTrader in case you are interested. It is created by Spotware and it is free of charge. You will find there are multiple versions of CTrader depending on the broker you're using, but you can also download the original CTrader from Spotware. They'll give you an instant demo account for you to try out their charting tools. So, I hate this. This is really ugly price action. Ew. Let's see. What am I trying to demonstrate here? I will take us to a different pair. Excuse me. So this is Euro CAD. Let's do the 30 pip range bar chart. Give it a moment and voila. Here we are. So in terms of internal range liquidity, what do we say? These are range bar charts, right? And I said that the range is the difference between 2 price points. So you can take each individual range bar chart and mark the highs and the lows and call that a range and look for a reason to enter a trade. If you are lazy, I'm not judging you. If you are lazy, here is something I want to show you. You can use a range bar chart, okay? There's something I'm going to point out to you. One thing I have noticed is typically the swings on a high range bar chart, they're very nice. Especially when I have 2 hammers in a row like this. I can almost always anticipate that the next bar is going to give me at least the same number of pips. So again, each one of these is worth 30 pips. 2 in a row, especially like this with the wicks looking like this. Look at another example. I'm trying to train your eyes. 1, 2. Okay? There's multiple of them like that. It's also a great signal for when I'm wrong about a trade. So like if I was buying here and then I see this and then I see a second one, I am all the way the fuck out. I'm not even waiting to check. And it's so lovely and so accurate that even on a 1 pip, because there was a time I used to do insane hyper scalping. And I would work with the 1 pip range bar chart and a 15-minute chart. I see 2 of these guys like this against me, I'm out. So this is something to keep in mind, something you could wait for if you are completely not in the mood to start overanalyzing things. So for the purposes of an example, let's talk about this, what we're looking at right here. If liquidity rests at highs and lows and a swing is a turning point in price, what is this here? 1, 2, 3, that's a swing. 1, 2, 3, that's a swing. Okay? Which means if you don't want to look at individual bars, this is a low, this is a high. What is this here? This would count as external range liquidity if I'm marking all of this from that high to that low. I don't think I've said this one before. So you start to see the many different ways in which you can frame a range. And mind you, the order blocks that I showed you, as well as the fair value gaps, can also be seen as a range, right? So I'm going to talk about the premium, discount, and equilibrium. Just give me a bit. In this particular example, let me mark just this. What did I say earlier in the live? If a high is getting taken out, the chances are the market wants to head down to take out a low, or at least head down for a little bit to give us some sort of retracement that we may have enough pips to take advantage of. This is a 30 pip range bar chart for the USD CAD once more. So if the market's coming here and taking out this high, I consider this a high that would be worth noting for a possible reversal because there's been a lot of time and space before we came back to it. So all of this right here, time and space, right? Before we came back. So once we have this bar, this red bar, do me a favor, act like all of this didn't happen. Now, what I'm going to do is mark the high and the low. And just like that, I have defined a range once more, which means I don't care what happens before this bar. If anything is playing out that does not play out in alignment with a sell, then I know immediately as the price is going up here that I'm wrong. This is why I love a range bar chart, right? Now let's go down to a lower time frame. We're going to act like all of this did not happen. I'm just going to put a line so you know where we're going. Now I'll go down to, let's try the 5 minute, and it's just 5 minutes just because I picked it. It's not that deep. You could pick any other time frame. So moving this aside, this very level here is the exact moment that that 30 pip range bar closed, that bearish range bar. This is where it closed. And then there was a little bit of wickage before it started going back. And this is where I want to introduce you to the thing that I briefly mentioned, which was the premium, the discount, and the equilibrium. You will have a range. The 50% or halfway point of that range is called equilibrium. At 50%, all buying and selling activity is at a balance. You're not looking to take any specific action here. But you do want to be on high alert because anything above 50% is called a premium, and you want to sell whenever the market is in a premium or the premium portion of whatever range you have defined. Now, this is a caveat. You do not want to sell every single premium portion of every range or you will get your ass handed to you. You are allowed to sell the premium portion of a range, number one, when the trend is bearish. Number two, when you have reason to expect a retracement on a high time frame in a bullish trend. So the only time you can sell in a bullish trend is if it is a retracement on a high time frame. And even then, you must bear in mind that you have to be really quick about taking your profits. So in that situation, ideally, when you have framed your range, if you're taking it from external liquidity, try to get out at 50% or just below it. Everything from 50% and below is a discount portion of the range, and you want to buy when you are in a discount. The thing about discounts to note is you are doing your buying only when the trend is established as a bullish trend, or if you are in a bearish trend based on the higher time frame, but you notice that the high time frame is now making a retracement or a pullback, then you can buy. But you have to be quick about taking those profits because there is a chance that the market may turn around and resume that bearish trend. And remember what I said before multiple times, the high time frame always issues orders to the lower ones. So in this particular situation, drawing your attention back to this square here, I don't know if it's visible enough. Let's see. Okay, I think that's much better. This square here is that 30 pip range bar chart that we marked out, okay? This is where that was formed. So your interest is very simply, you're going to find 50% of this range, and then you're going to move your cursor just a little bit above it, and then you will set an alert. And then when the price hits that point, option number one, you could jump in for a sell right away and have your stop loss at the high. Option number two, you start looking to the left. What is the liquidity that you could take advantage of here? And in this case, what do you have? You have a fair value gap. And notice how the market wicks through that gap. Let me zoom in a little, try to make this a little clearer. Let's see if I can make this easier to see. Hang on a sec. It's about the best I can do for now. So you can see how this is a fair value gap because look at this low, it gets broken. What does it leave behind? This fair value gap and this fair value gap. In this situation, please always allow the price to come back to the first one. Or if you're going to jump in right away, make sure your stop loss is far away enough in case the price wants to retrace into the first one. So in this situation here, the market pulls, you have that alert, it fires, and then you're looking left. Notice how you don't have any business with anything on your charts before this range. It makes life simple. You don't have too much to look at. So now you see this, and then you're like, cool. And then you see this rejecting, and you're like, cool, okay, I'm going to jump in. Option number 2, this is a 5-minute chart, remember. So let me put this here. Option number 2, as soon as the market hits that 50% point, you could go lower. Let's go to a 1-minute chart and see how you might have had a much better entry. So this is that area here. I'm going to crave your indulgence and delete this square because I need you to see it clearly and I need to be able to maneuver. So this is that area here. Option number 2, you have that 50% hit. It's hit now at this point. So now all you're looking for is you're waiting for a low to get broken. Those of you who do not care about waiting for fair value gaps and order blocks and things of that nature, look here. Remember, this wick is rejecting this fair value gap here. This is a 1-minute chart now. So I'm bringing you back here. What did I say about swings? A swing is a turning point in price. And I said you don't want to take every swing you see. However, if a swing is hinged upon the idea of liquidity, which it is because this is a swing that is rejecting that fair value gap you saw on the 5-minute chart, you could have easily entered upon the close of this candle with your stop loss over there. Option 1. Option 2, the market creates this low, you wait for it to break. If you do not like stress, you could enter right away on a break. It's just that your stop loss would be wider. No problem. Option 3, let's zoom in a little closer. This is the low. This candle breaks that low. It also had rejected a fair value gap. You did not have to wait for the break of a low since you know already that this swing is rejecting that 5-minute fair value gap. So once you saw the market had created this gap here, you could have gotten in and had your stop loss there. Option number, I don't remember at this point anymore. Here we are. You don't like this because the price action is confusing? No problem. Then keep waiting. You have this gets broken. Great. Once it gets broken, what happens? You have another bar here, that's a doji. There is a tiny fair value gap here. You could have put a pending order here. And because I don't like this gap and I anticipate it could get filled, I personally would have my stop loss above the swing here. And there you go. And eventually the market takes a tumble. So let me go back to the 30 pip range bar chart so you know exactly what it is we framed that trade on. Remember, it was this guy here. So wherever you had found your entry, you would just calculate, okay, what's the high that this new bar has created so far? And then project it down by 30 pips. And then that would be your take profit. Option number 2, you could have exited at the close of this bar here, which you were using to frame your charts. So what I have just described for you is an example of trading using or going from internal liquidity to external liquidity. Now, I am very particular about teaching the idea of simplifying and stripping everything way the fuck down. What I mean by that is you do not need to learn every single ICT concept. You don't need to know all the strategies in the world. I promise you, if you've been having trouble, every time you open up your charts, all you feel is analysis paralysis, strip everything down to just 1 or 2 approaches, which is why I'm not teaching you any other kind of internal liquidity apart from fair value gaps and order blocks, which is why I don't use all the other fancy terms like change of character, blah, blah, blah. I'm trying to keep things simple for you. I promise you can make money with simplicity. Simplicity is where the money's at. All right. So this I've shown you right now is an example of trading from internal range liquidity. Internal of what range? This range here that already closed. Taking that money to the outside. Where's the money coming from? Somewhere inside this range. Where's the money going to? Well, definitely at least the close here. Is there enough room between both places to take something? Let's see. About 11 pips, 15 pips, maybe a little bit more if you're gunning for the close of a new range bar, which is great. Remember, those are the 3 questions we're asking over here. Now, let's look at an example of trading from external range liquidity to internal range liquidity. And for that, I would like to show you, let's take you somewhere else. I think I may be able to find something worthwhile on the Aussie dollar. Probably not the 30 pip, but let's see. Aha, perfecto. Okay, so here we are. We have, remember what I said about these? That when I see two of these in a row, I can generally assume that there's going to be an opportunity to take some money further to the downside. So I would not be wanting to trade against these double and then in this case triple wicks. So let me show you an example now. This is me using only the range bar chart for my analysis and not using a high time frame. I'm just focusing on ranges here. So we have this push, 1, 2, 3, and then we have this guy push up here. And I'm asking myself, what are the odds that the market is ready to continue going to the upside? I don't know. I am not a fortune teller. This is not the business of fortune telling. This is a business of finding opportunities and exploiting them. If the opportunity works out, great. If it does not, then it does not. And you move on to the next one. It's never that deep. So let me make this a little bit easier to see here. This is the Aussie dollar 30 pip range bar chart. This is all of that, okay? So now, remember what I said. I've seen 1, 2, 3, and I'm asking myself if I should trust that this guy is an actual reversal. What if it's just a pullback to continue the trend? But remember, we haven't seen this guy yet, so we don't know. So how do we figure this shit out? Great question. We go down to a regular time frame chart. This is the 5-minute now. This is that square that we marked off here. This is the very moment that the market created this bullish 30 pip range bar. So in this particular instance, all I would be waiting for, now this is me personally, when I see a sprint, I call it a sprint. Maybe there's an actual term ICT uses for it. I don't know. I just made this my own. I call it a sprint. When I see a sprint, which I mean by a long series of just candles all in the same direction, I don't like that time frame, so I go for something higher that gives me more clarity. And I can see that sprint here as well, but at least it's better because I can wait a little bit. What happens? And notice we have this low here. The market pushes up, pulls back down, starts to push up again. There's this low. Here's this low. Push up, pull back, here's this low. Push up, pull back, here's this low. Push up, pull back, here's this low. Gets broken by this guy. Great. I would be looking within here for a reason to sell. But then what happens? And I like that this example did not work out because I need you to see that sometimes it does not. What happened in this case is the market pushed all the way up, boom, and would have cleared me out if I was trying to use this as an order block entry. But then we come to the concept of relatively equal highs. Notice how the market pushed here once, twice, and thrice, and that each time it did that. What's going on? We have people who are selling here. They have their stop losses above the highs like they've been taught to do, right? What's just happened here is an example of engineering liquidity, meaning that your stop losses are basically money for the people and the institutions that make the markets to take and pull off in the other direction. How do you know? This is the hint here, this wick. Think about what a wick is telling you. Think about the story of this candlestick. It opened. It gave a very tiny wick to the downside, suggesting that the sellers had no chance. And then it pushed up. Remember, at some point, this was a very huge bullish candle. And at the same time, while this is happening, people are thinking, holy shit, guys, it's actually a breakout. Buy, 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 buy. Especially the breakout traders, right? But then the clue comes that it may not be what it seems like when it finally closes. Because try as the buyers might have to push things beyond this point, at least that's the story, there was selling pressure coming in here. Or if you're not looking at the story that way and you're using the algorithms and whatnot, you're looking at market makers. The whole point is, this is to make you think that you are going to have a successful buy trade while at the same time also clearing those people who are selling too early. And now what? The highs have been taken. That's sign number one, that maybe, just maybe, this is not actually trying to go up. Sign number two, you have this bar here. Sure, it's bullish. Sure, it closed higher than this one. But notice it is a 1, 2, 3 swing formation, a swing high. And remember, you have framed this trade with that range bar chart. This is the top of that range bar. So you are not looking to be a buyer. If you see something like this, you just try. You put on a reasonable amount of risk, not your entire fucking life savings. You're in it here at the close. You have your stop loss at the high for a beautiful just 5 pips. And then what happens? The market actually shits itself. And what do you target? Look at that same setup over here. You have these lows. Notice how each of these lows, it's like none of them, the subsequent ones, they're not taking out the last low. What is happening here? People are buying. They have their stop losses here. What did I tell you at the start of this live? If the market, you have a range, the market's taken out the high, odds are, where's it going next? To take out the low. What did I tell you at the start of this live? Everything that you see on every chart, I don't care what you trade, it is all just a story about moving money from one place to another. And that's what's happened here. So let me show you another example. Let's take you to a 10 pip range bar chart for those of you who like to scalp. Now, the thing about me and the 10 pip is I will generally not touch it unless I have seen something on a regular time frame, like the M15, that would suggest to me, maybe I should look at it. So let's do this example right here that I see. We have this fair value gap here. Let me change the color. Give me a moment. Change this to something. What the hell? Lighter, please. Thank you. Zooming in because I need you to see it. So this is this fair value gap here, right? And let me put a vertical line so we can see exactly what took place from here. And now I'm going to go to a 10 pip range bar chart. Not the best. Let's try 5. Wait for it to load. Okay. So in this case, what do we have here? That fair value gap is formed, then you have this bar. What can you do with this bar? I like to call it like an anti-bias bar, because the whole idea is I have a bullish fair value gap, but here's this guy. I like when I get this, but even better, I like when I have this example, and I'll show you what this looks like. So what do? All I'm doing is I'm coming down to a low time frame, in this case the 1 minute chart, and all I'm waiting for, very simply, is for the market to eventually put in a high that it breaks. So it has this high, it pushes down, pushes up again. Now, bear in mind, because we know what we're framing this on, if I see the swing here, it could be a viable option to take. But I'm mindful about my risk, and I'm aware that it could very well come back and kick me out and prove me wrong. However, what do you have here? This is a low. It got broken by this candle. And then this candle formed. What do you have? This is a bearish fair value gap, right? When I see this setup, I promised I was not going to confuse you. When I see this, pure selling, and then you have this candle, then it's like pure buying on the other side. So almost like it's, and they would call it an inverted fair value gap, or what you call it, a flipped one. I don't know the term, bro. But I do know that it's usually a sign I could trust that perhaps the market's ready to flip over. But let's say you don't want any of that stress, right? What do you have here? You have a high. Let me zoom in so we can see this better. Come on now. We have this high. It gets broken by this guy. What did I say? If you don't give a shit about fair value gaps, you could enter as soon as you have a break and close, have your stop loss below the swing, and then ride that shit. Option number 2. Ugh, this is frustrating. Option number 2, what do we have here? We have this swing, 1, 2, 3, right? The market pushes up. 1, 2, 3, we have a swing high, and it starts to retrace. Once you start getting that retracement, guess what this is? This is a range. What did we say? You're looking for what lies where? If you want to buy the discount portion of the range. So when you have a swing, then the market pushes one way. You have a swing for a retracement or a possible reversal. You don't know that yet, remember? Once you get to that 50% portion Slightly lower, what do you have here? The market pushes into it and gives you 1, 2, 3. That's a swing. You could have jumped in there. There's so many different options. If you are the kind of trader who uses trendline breaks, what could you have done? Well, you could have, you could have set up a trend line from, I don't know how y'all do that. I'm not a trend line trader, but I'm guessing from here to here. You could do that. Oh, there's a break. Great, awesome. You do breaks and retests, you do pure break and market structure. It doesn't matter. The point is you framed all of that on the concept of liquidity. So when people ask me, what is your strategy? I don't think of liquidity as a strategy. I think of it as a story. It's just a story of price. Okay? It's literally a story about how the government is printing money at the mint, or whoever's printing money, and they have to get it to the bank. And me, an ordinary citizen, my job is to just jump in the middle and figure out how to take some from that bullion van before it gets where it's going. I'm speaking figuratively, please. If you miss that, here's another option. You had this high here, then we push down, create this high, it breaks. This candle closes, what do you have here? There's that fair value gap. Notice how this candle here taps into the fair value gap, and you'd have been off and running. All right, let's go back to that, was it a range 5 or a range? I think it was a range 5. Let's go back to that 5 pip range bar chart because I want to show you another example. For me, I don't like, now this is full disclosure, I like to trade this setup when I see that the bar in question, so let's pretend this is actually it kind of is a fair value gap, and this bar trades down here. Okay, so you see there's even fair value gaps on range bar charts as well. And you'll be surprised at how accurate they can be. So in this case, this bar that I'm marking the high and low of has traded into it. And then we're here. For me, the best bars I like to use are the ones without wicks. So look at this example. It had a wick to the top side. I prefer the ones without wicks that are this long, and I prefer when the body close is very close to the low of the previous candle. The same thing applies on the flip side if you are trying to sell. All right, so I prefer when it's a full close to the downside like this. Now let's go and look at how this would have played out here. So I'm going to put this line so there's no confusion. Once more, we'll go down to the 1 minute chart. And this is how you can scalp and be done for the day really quickly if you wanted to. Remember how we talked about external liquidity? And remember how we talked about the swing being the turning point in price? So here, do not send me invitations to co-hosts. Just turn the shit off. Look here. 1, 2, 3. That's a swing low. That could have been your entry. You don't like that? Fine. Let's zoom in a little closer. What do we have? This is a high. This is a high here. Now, this is the one time where you may want to use a wick. I don't like it, though. I prefer closes. But if you wanted to use a wick, because you're dealing with a very short range frame, it's a 5 pip range bar chart, which means you're looking for anywhere from 3 to 5 pips, maybe 10 if you want to hold it and see if it continues to go, right? So in that case, we may say, okay, fine, let's look at this wick as a break here. And then let's look at this guy here, this last bearish candle. That's our order block. The market taps into it. Your stop loss would have been about 1 pip, and then you take off when you're running. You don't like that? Fine. Keep waiting until you see something clear. And if in all of this noise here, because you may be somewhat brand new to this, you could not find yourself an entry for the life of you, that's fine. Because guess what? The market will provide you another opportunity on a different pair. We're not here to rush. We're not bringing desperate energy to the charts. They're open 24 hours a day, 5 days a week if it's Forex, 7 days a week for synthetics and cryptocurrency. We have no reason to rush at all. None. So I have shown you how to trade by using internal range liquidity to trade to external range liquidity. And I've shown you how to use external to trade to internal. If you want to make sure that you are on the winning side more often than not, or that you're making money consistently, here's a tip for you that you may or may not listen to, but you will eventually listen to one day, of which I'm sure. Pick one. Pick just one. You don't need to know everything. You don't need to do everything. Pick just one. Decide, what are you? Are you an internal to external range liquidity trader? Then that's what you are. Are you an external to internal liquidity range trader? Then that's what you are. And I've shown you all of this on a range bar chart, but it's the same thing whether you're using a regular time frame chart or not. So if you're an internal to external range liquidity trader, what is this? This is what? This is an order block. This is the range here. Sorry, not order block. This is a fair value gap. Let's mark that out so there's no confusion. Here and here. Let's drag that out. Pardon me. Okay, so you've decided you are an internal to external range liquidity trader, which means you don't care about old highs and old lows except to use them for exit liquidity. Your entry liquidity would be fair value gaps and order blocks. And you could decide to refine that and just say, you know what? I'm only going to focus on fair value gaps. You don't need the two. I just taught you two, so you have two examples to go look at, and then you could choose one, and you could kill it with just that one. Or you could merge the two if you want to. That's really up to you. But I'm telling you, it's just simpler when you only are looking for one thing. It's so easy. Well, simple, not easy. Because for it to be easy, you're going to need a lot of time and practice and a lot of, well, psychological work. Not to insult you, it's just the way it is. So you could decide that, or you could say, I'm only interested in external to internal. So in this case, let's see this example here. This is a high. Mind you, this is the Aussie dollar in the 15-minute time frame. This is a high here. And then the market has given it enough time and space before returning to the high. So there is some room, time-wise, space-wise, on the charts, okay? It's returned here. And then you're just going to go down, because this is a 15-minute chart. You could go to a 3-minute, a 1-minute, whatever. It's up to you. There's no hard and fast rules for this. You go here and you're telling yourself, look at this. This is that high, remember? Now we've traded back into it. And all you're waiting for is, okay, I'm looking at this low and waiting for it to break. But what happens? That does not happen. Instead, the market goes on to create a new low. Okay, we're waiting for that to break. Instead, it goes and creates this low. Okay, we're waiting for that to break. You kind of get a break, but it's a wick, so it's very meh. We don't like it. So now we're going to wait for this guy to break. This wick's through. I don't give a fuck about that because it's a wick, not a break, and it's a low time frame. Or if you wanted to go along with it, that's still fine because it's a low time frame. In this case, that you're using the M15 as your high time frame, if that makes sense. Remember, this is M1. Eventually, though, you get a break here. Boom. Once that break happens, the next bar closes. Boom. What do you have? Fair value gap. And you could just have a pending entry here, your stop loss above the high, and then you write that into, because that was external liquidity, so where are you writing it into? What did I say? You have a swing here, and now the price has created this turning point here. So you mark from this point to this point, 50%. You exit at 50% or just below 50%, because if you're selling, when you're liquidating your sell trade, it might as well be like buying. So you exit either at 50% or discount. You see how that works? This is a range, this low to this high. All right? So here's another example that I'll show you, or rather the same example. Let's go back to the 1-minute chart. One thing that I did not tell you is that even your fair value gap is a range, and I'll show you that. Hold on a sec. So look at this here. I'm going to move this out of the way so there's no confusion. You have this low, it gets broken, remember, and as soon as this candle closes, that's a fair value gap, right? Notice it's a range of its own. So one of the things you could do, while there will be sometimes the market will literally just tap a little bit and then take off, if you wanted to, you could wait for the times when the market will come into, this is 50% of this range. Slightly above it is what? Premium. The market comes in here. You could be waiting with that pending order. So as soon as the market's trading in here, okay, you're getting ready to sell. All right? You don't want to do that? No problem. This is an engulfing candle that engulfs this guy here. All of the trading patterns that you've been taught on baby pips and co, and you keep wondering why they keep failing you, is because you're not incorporating them in the correct context, which is number one, the context of the trend, and number two, the context of liquidity. In this case, said liquidity would be this fair value gap. All right. So it is currently 12:22 p.m. and I'm going to call it a day here. If you missed the start of this live, that's not a problem because I will be uploading this. I will be uploading this to my YouTube channel, which is linked in my bio. And you can also go check out the Telegram group if you have questions, you're wondering what's up. I'm going to be very clear about this. I am not for beginners. So when I first came on here, I was still trying to find my voice and figure out who I was trying to address. I'm not for beginners. If you are a complete beginner to trading, what you need to do, please, is go to babypips.com. That's BABYPIPS.com/learn. I'll say it one more time. BABYPIPS.com/learn. Another great resource is learntotradethemarket.com/forex-university. I'll take that again. Learn to trade the market, singular, not markets, .com/forex-university. So you go there, you can learn the basics about what a pip is, what the spreads are, and all of that stuff. My audience specifically, or at least the people that I want to reach out to, are those who have been trading for a long time, but for whatever reason have been unable to find consistency. So that's my specific audience, which means that they already understand a lot of the nuances, they understand what a trend is and all of that. So all I'm doing is taking a strategy, or rather, not a strategy, the story of price as told by Michael Huddleston, ICT. Some people claim that he actually did not come up with it and that he just repurposed it. I don't know anything about that. I just know that that's where I learned it from. I don't really care about the man's personal life. I just take what I hear and I go and check it out for myself to see if it's accurate. And I would like to urge you to do the same thing, please. Like I always say, I love me a skeptic. I need you to be skeptical, but I don't want you to be a skeptic for nothing. What I would prefer is that you take everything that I've shown you here tonight and you go back to your own charts and you look for these things for yourself. When you're able to see them yourself and prove them for yourself and use them for yourself, then you'll find that there's some validity to what I'm saying. Please do not take any of these concepts live if you are not yet used to them, you don't understand them, you've never heard about them before. Use your demo account, but treat the demo account as a live. Like, take it that seriously, okay? If you like the idea of being able to switch from a regular time frame chart to Renko charts and to range charts, once more, the software or the platform that you're looking for is called C Trader. That's letter C and Trader, all one word. You can download it for free from spotware.com. That's SPOTWARE.com. Again, SPOTWARE.com. Hopefully I'm getting that right. If you check the Play Store and the App Store, you will find there are multiple versions of C-Trader, and that's because every broker has their own version. So if there's a broker you like in particular and they have C-Trader, you can download theirs and create an account and all of that stuff. What else is there to say? Right, I have a Telegram group. You can join in there. There's an option for mentorship. It is not compulsory. It's not mandatory. If you cannot afford it, all right, you do not have to. You can just keep coming to the lives, which now take place 11 p.m. West African time, Mondays through Fridays. So Mondays to Thursdays, I talk about the charts and show you how you can get in and out of trades and all of that. And then Fridays, we talk about strictly psychology type things. And we get into a little bit of woo territory, but that's for Friday. Okay? What else is there to say? I would never DM you first. If anyone's DMing you first claiming to be me, it is most definitely not me. If you have questions for me or you'd like to reach out to me, I adjure you to please attach the question to whatever it is you're saying. Don't just say hi, I will not respond. Don't just say hey, I will not respond. Don't just give me a compliment about my eyes or things that are not trading related, I will not respond. And make sure whatever it is you're asking or saying is strictly related to trading. I beg you, let's all be adults here. This is a profession. Let's be professional. Thank you very much. And now I will go to your comments and see what needs to be addressed. Can I use 45 minutes as my higher time frame and 1 minute as your lower? That depends on whatever it is you're trading and how you like to approach the markets. It's entirely up to you. It's an option. The whole point is you have something you use as a high time frame. Sometimes I will use the 15-minute chart, like if I'm trading GBP CAD, for example, because I know it has wild swings. I'm happy to use the 15-minute chart as my high time frame, and then I will go to the M1 or even tick charts, which I didn't talk about in this live for a reason. So, and then use that as my entry. That really depends up to you. It's up to you. Afro Ninja, I will download the video as soon as the live is over, and then I will upload it to my YouTube channel. I will make the distinction by, I'm going to just put a date on there so you know which video is which. Charlotte, you're very welcome. You guys can join the Telegram. It's very lively in there. If you are brand new to trading, you're going to need those resources, please. And for me, it's also a way to screen and know who's actually serious. Some people think they want to trade, but then when they realize how much is involved and how much they have to learn, they get very lazy. And also a very clear point, please, regarding the mentorship, it is not for new traders. I'm not going to walk you. We're not doing that, okay? I need people who understand this craft is about risk, who understand that this craft means understanding that there's going to be losing trades sometimes. Okay, I need people who understand those things, because as a newbie, you kind of come in with certain expectations that are very unrealistic. And I do not want to encourage those unrealistic expectations. Also, if you're joining the group hoping for signals, I do not give signals. What I do is empower you to be your own signal provider. I will not rob you of the chance to discover your self-confidence by feeding you with signals. I think that you're doing yourself a huge injustice if you don't actually put in the work to learn for yourself. So I will not do that. This is not a GFU scanner type group. If that's what you're looking for, I'm very sorry. You may want to leave now. Let's see what else we have. Ocean, you're very welcome. Thank you. Let's see the more recent comments, if anything. Thank you for the follows and the likes, guys. I see you. How long do you usually hold your trades? You hold your trades for as long as you need to hold your trades. So if you're understanding anything at all about what I just shared today, it will take as long as it takes. I cannot answer that question. If I'm trading with a short time frame, it's obviously going to be a very quick trade. But if I'm using something high, it's going to take as long as it takes. For instance, I had this, what was that? Ah, damn it. Wow, I really need to sleep. I was in trade from like 3:45 all the way into the close of market today, which is not usual for me. But yeah. Trevs, thank you very much. I appreciate you. Who else is there? Aggressive trading. I first confirm the bias and then wait for the Asian low liquidity sweep, then TP at the opposite swing. Thank you, Smiley. Do you trade only stocks and forex currencies, or do you also trade? No, I don't. I'm not interested in meme coins. I don't touch them. I don't do stocks either. I just do forex and I do S&P 500. That's the only index I touch. Everything else, not really interested. Microsoft, you just did go. I'm sorry. You'll get the recording. The recording will be on my YouTube. Well, I see you're very welcome. I appreciate you. Ubanga Sikazwe, I appreciate you too. Thank you. Thank you very much. Trying to see what else I may have missed. What's my channel name on YouTube? The link is in my bio. Thank you, Freddie Black, for typing that. I appreciate you. Thanks for typing out the link. babypips.com/learn. Yeah. And the Forex, the learn to trade the markets.com/Forex hyphen university. Sabio, you're very welcome. Thank you guys for the follows as well. I appreciate you. Sorry that I do not look at comments when I'm talking. It's because I will be distracted, and that's not good for you because I need to stay focused. 10 deep. You can check out my YouTube. I will upload this in a few hours. I'll upload this to my YouTube in a few hours. What else do we have here? I feel like I've covered. Let me see. There's some new comments. What's my platform? C Trader. Letter C, TRADER, all one word. Which Forex broker do I use? Let me allow that comment. Excuse me. Which Forex broker do I use? IC Markets, letter I, and letter C, Markets. And before that strange fellow that came the previous live to tell me it's not regulated, sir, I have been at this game for 10 years. It's based in Australia. Look it up. Do I trade futures? I just do Forex and in one index, which is S&P 500, which I haven't even touched in a while. The best platform is relative. A lot of people love TradingView. I don't. I think it's overrated. But that's my opinion, not law, okay? And that's probably only because I already have what I used to do. I think people join TV. I could be wrong, maybe because of the backtesting abilities, but I already have something to backtest with on MT4, but it was paid for, so I'm not about to recommend it. Klinks12, thank you, I appreciate you. How much is my mentorship? Details about my mentorship are inside the Telegram. It's a pinned message, so just flick through all the pinned messages, you'll find them. Please, once more, if you are a beginner, don't. I will immediately send your money back, like right away. Okay? We're not looking for beginners. And I only have room for 5 people. I keep saying that because I only have so much time. I give as much as I can on here for free for over an hour. So I'm not planning to stress myself. 5 people is enough. Why C Trader? Why not MT5 or MT4? Because C Trader is not like those things. Because C Trader, if I wanted to have a range bar chart or a Renko bar chart, MT4 and MT5, if I wanted to have a range bar or Renko bar chart, I have to start downloading indicators and they don't all paint correctly. And it's not, to me, it is not sleek, bro. That's just me, it's a personal preference. If you like your MT5. Who we this? Wow. I see a scammer on here. Oh my God. I'm flattered. Let me go and see. Not you actually coming here. I must be doing something right. Yo. That's wild, bro. That's wild. Excuse me a second, guys. I have to take care of this right away. TikTok and your horrible reporting options, bro. Like, how am I going to explain this now? Misleading. So, guys, I don't know if you spotted it as someone in the comments. That's not me. That is not me. If you message that person messages you, you're on your own. I'm following exactly 4 people. I'm following 4 people, and I will never follow more than those 4 people. Okay? Ever. So be very mindful. I'm following just 4 people. I'm just going to take that as a sign that I'm doing something right. All right, so if there are no questions, any actually depends on if volatile. Why is FVG liquidity? Yeah, bangun dan bank it. I think you need to rewatch the live from the start. I will be uploading it to my YouTube. Thank you, Freddie. Thank you. Okay, it seems that's about it. No questions or anything of the sort. I'll be here tomorrow. Again, same time, 11 p.m. West African time, Nigerian time. We don't do daylight savings, so it's always 11 p.m. And that's going to be about it. Just keep pulling up to your live. Oh, yeah, 10 deep. You're very welcome. I appreciate your presence. I appreciate you guys showing up. And more importantly, please try to actually look things up for yourself. Look things up for yourself. How you will know it's not me also is if I'm trying to sell you anything. The only thing that I'm selling is time that I'm not offering for free, and that person will not be able to do that. That's one. Two, the only thing that I'm selling, it's not even a selling thing, honestly. It's just because I know some people actually want the option. I've had some people reach out to me, say they're trying to gather funds to pay and stuff. So that's just the mentorship, and it's just 5 slots. And once the 5 slots are done, they're done, and I will let you know. Smile, I'm very happy that you learned something. You're very welcome. Hey, smiley. Gracias. A girl she tired right now though. So I think I'm gonna go to bed. Thanks for the roses, 10 deep. All right, that's pretty much it. Please be safe, guys. Tomorrow, remember, I want a community of snobs. I want snobbish people. What do I mean by that? I mean, when you're trading, you don't take just any setup. If you can't answer the 3 questions, guys, where's the money coming from? Where's the money going to? Is there enough room to take some for myself? You don't trade. We want utter snobs, okay? We don't settle for less. Thank you for the roses and everything, 10 deep. I see you. Freddie Black, hey, thank you so much. Yeah, guys, join the Telegram. It's actually popping in there now. Thanks to Innocent and y'all doing things. Freddie's doing things too. It's popping. So join. Okay, that's about it, guys. Thank you very much for being here. I appreciate you. You could have been anywhere else, but you chose to be here. Thank you. But more importantly, thank you for investing in yourself. I believe in you. You've got this. This is not a journey of you learning as much as it is you unveiling yourself as the master trader that you actually are. As I always say, I will continue to look at you as a master trader until you're able to see that for yourself. May the markets favor you. Good night.